Welcome to this evening's presentation, Unlock Tax Efficiency, Moving Your IRA or 401k from the US to Australia. I'm Ashley Murphy, CFP, GFP Fellow, and founder and principal of Arete Wealth Strategists Australia. Let's get into it. Now, of course, just a few disclosures before we get into the material here. This does not constitute personal tax or financial or investment advice. If you are a client of mine, then we will go through this in your specific case and details, and there may be nuance to that particular journey. But if you are watching this and you are not a client of mine, then please note this is general information only. All material has been sourced from what I believe to be reliable sources, such as the IRS, the Australian Taxation Office, or major US custodians. Do note, I have a YouTube channel. If you register, you can't make it live to a presentation, then be sure to register, because if you do, you'll be notified of when that recording is available. For instance, last month's recording, financial planning considerations for mixed nationality couples dealing with that decision of whether to opt for that 6013G once in a lifetime opportunity to opt a non-US spouse into the US system. That's up on YouTube. Feel free to subscribe to my channel. If these are topics of interest to you, it really helps me out and the channel out. A little bit about me. So I am a tri-citizen of the US, the UK, and Australia. I moved to the US in 2005 after completing studies at University of Queensland in IT and business management. And it was around this time that I began looking for financial advisors that could help with my own cross-border situation. But it wasn't until 2008 I began to study the CFP myself. And then after networking for years and years to try and find some organization that was dealing with cross-border matters, I eventually started the Global Financial Planning Institute, where we now have over 500 members, financial advisors that I and my executive team there train in how to work with financial lives, the clients whose financial lives cross borders. Some examples of the kinds of clients that we work with and the kinds of issues that we assist with. First would be the Australian business owner who was living between the US and Australia. She's now settled back in Australia. Her goal had always been to settle back there, and she'd hoped to do so in the most tax-efficient manner. I'm very, very pleased with the result that we're able to obtain for her, given an installment sale of her business in New York, and she is enjoying the fruits of the labor that she had in the US for several years now, back in Sydney, having just bought a house. High net worth Australian family currently living in the US. It turns out they actually moved back to Australia, but there was an enormous benefit given to their situation with making them aware that they would soon become long-term US residents subject to an exit tax. And so they were able to change their US immigration status and avoid that clock starting on them altogether. So we put together a global team of CPAs, tax attorneys, financial advisors, able to assist them on both sides, so the US and Australia. And then lastly, an Australian executive and his family permanently relocated to the US. Looking forward to talking to this particular client tomorrow morning. This has been more of a re-domestication from Australia to the US over many years, selling in Australian so-called investment real estate, getting tax opinions on how superannuation would be transferred, what the US would take of that account, and of course all the other domestic issues that go with an executive client, like a deferred comp plan, 401k, multiple 401k plans, et cetera, et cetera. So he is set up and looking very good for his dream retirement. So this evening, thank you for joining me. Let's see what we're going to be talking about here. Firstly, we need to define what a US person actually is, a US tax resident, what their tax treatment of a US retirement account would be generally if you're a US tax resident versus if you've departed. What's the situation there as a US person, as a non-US person? You'll find whether you're in the US or not, if you're a US person, that the treatment is exactly the same. Next, we'll look at when you can get your money out of your US retirement account. How does that differ being a US person once compared with a non-US person? Options for distributing that account. What's the appropriate tax withholding? What to do if your account is over withheld. That's really only going to happen to non-US individuals. Is now a good time to possibly move funds? How to convert your funds most efficiently back to Australian dollars? What to do with your money once it's back in Australia? Superannuation contribution limits and strategies for recontributing back into super. And lastly here, the ATO's taxation of 401ks and IRAs for US persons and non-US persons. Okay, let's get into it. So key concepts and definitions here. I'm going to look at four concepts here. There's the comparison of the tax systems. This is important just to set it up and explain why the US is unique. Next, we'll look at the definition of what a US person is. You would think that that's fairly straightforward, but there's nuance and detail that we need to understand. Next is tax and investment considerations as a US tax resident abroad. I raise this so that the folks here tonight have an understanding of what it is that they are voluntarily subjecting themselves to if they plan on staying abroad permanently as a US citizen. It can certainly make a lot of sense depending on your situation and your feeling about the US and possibly returning someday. But more often than not, it's something that can be an undue burden. And fourth, we'll look at options for account distribution. There's really three broad strategies that US individuals can employ. Okay, so a comparison of tax systems around the world. So at the top, in the top row, you see here, we've got countries such as the Cayman Islands, British Virgin Islands, Bahamas, UAE. These are no tax systems. There's no tax at all, so really quite no income tax. At least they don't miss you for sales tax in the Bahamas. Territorial tax system, that would be similar to Hong Kong, Singapore, Costa Rica, or what is about to happen in the UK. Apparently, the Labour government, Sir Keir Starmer, and his Labour Party has said that they want to get rid of the non-dom taxation system there, and that is a territorial system that applies to the non-doms, where if you come into the UK and you say, well, we're not really domiciled here, then you'll only get taxed on your UK-sourced income. So if you happen to be a Russian oligarch and you've got your billions stashed away under Vladimir's system back in Russia, hey, that's okay, not a problem. You're not going to get taxed on it in the UK because that's happening abroad. Now, I say that tongue-in-cheek. There's sanctions and so forth, so that an oligarch would have a whole lot of difficulty getting their money over to the UK. But I mention it as a joke to say that these funds would be taxed, would not be taxed by the UK. Next is residency. That's the system we're going to be most familiar with in Western Europe and Australia. And that's to say, if you are an Australian tax resident or have Australian sourced income, namely from real estate, businesses, or trusts, then Australia will tax that because you're in Australia or that income is deemed to have been derived from Australia. So that's a residency system. A citizenship-based system is what we see in the US, and some would say Eritrea, and increasingly China also, but certainly the US, by virtue of what's included in the model tax treaty language, and that includes a phrase known as the savings clause. And it's a clause that says, essentially, if this tax treaty didn't exist, we're going to continue taxing you as if you were a US individual. So you're going to derive no benefit whatsoever from this tax treaty. If you could, because you're a US citizen, we're just going to continue to tax you as if you're in the US, no matter where you are. And so the UK shows up at the bottom there because of that non-dom system that I was mentioning a moment ago. So who are these US people, these US persons? The technical term for it would be a US tax resident. You're a US tax resident if you're a US citizen, you're a legal permanent resident who has not submitted an I-407 to relinquish that US permanent resident status. And by the way, it doesn't matter where you are. If you're a citizen or permanent resident, you could be in Antarctica or Zimbabwe or any other country between A and Z, and you will still be a US tax resident. Or the third option is if you have been in the US for more than 183 days in the current year, or there's a formula, it's 1/3 of the days in the prior year, 1/6 of the year before that, which means that with simply 122 days in the current year, if you had spent 183 days in the 2 years prior, then you would be a US tax resident by way of the substantial presence test in the current year. So it doesn't matter where you're living, as I mentioned. Now, why is all of this important? You're probably inferring this from the first slide to do with the tax systems. So what have we learned so far? The US taxes based on quote unquote citizenship, which really means citizens and permanent residents or folks that satisfy the permanent, the substantial presence test. And now we're learning what the complications are of being a US tax resident abroad. One, annual US tax filings and information reporting. And the penalties are stiff if you fail to file your FBARs or FATCAs. Starting at $10,000 for willful non-compliance there. This is one of these points that I think is underplayed by folks, because you're on this hamster wheel, this 6-month hamster wheel that's actually worse than that, because with your US return, often you can't even file that for at least a year until you have the Australian information to put in the US return. So you're in this tax purgatory that lasts forever and ever, constantly filing tax returns every 6 months, but with delays and extensions and so forth. Next, investment restrictions due to passive foreign investment company rules. I'm going to be talking a little bit more about that next month. And actually, next month is really intended to be a follow-on from tonight's presentation to do with where should I be keeping most of my money? Should I be keeping it in the US or Australia? And there's a ton of things we need to consider when making that decision. And it varies by individual, of course. So investment restrictions and PFIC is certainly a nuisance. Next, estate tax considerations for US situs assets. So if you keep assets that are deemed to be sited, that's Latin for sited, located in the US, then they are going to be subject to US estate tax rules. Not so bad for Australians, as it turns out, because Australia and the US have an estate tax treaty, which does grant some portion of the estate tax exemption. It's now up around $13 million per person, set to sunset at the end of 2025 when the Tax Cuts and Jobs Act expires. It's going to come down from 13, maybe it'll be 14 next year, all the way down to 6 million in inflation-adjusted terms. Still, it sounds funny to say only 6 million. But that's what's set to happen. Should things change, watch this space, because there's going to be plenty of action in 2025, no matter who wins the presidency. So there's the exit tax. Next is the US taxation of foreign retirement accounts. And that's a tough one, especially if you moved to the US long before even, if you accumulated funds in a superannuation account long before ever thinking about moving to the US. Doesn't matter. The IRS is going to reach deep into your pockets and tax you on that superannuation account. Now, why would they do that when that's so patently unfair? Well, the reason they do it is because they look through the Internal Revenue Code and they don't see any references anywhere in there to a system called superannuation. They look at that and they say, we need to make sense of this account under the tax laws that we have. And the tax laws that we have say that this is either a foreign grantor trust or an employee benefits trust. And we're going to have to figure out what the basis is of that account and then tax it accordingly, depending on which tax treatment applies. And then lastly, this doesn't come up quite as much, but I did see it yesterday for a client. Income tax asymmetry and capital gains tax asymmetry due to foreign exchange translation. Now, I'm sure all of us are English speakers and we all know each one of those words, but what does it mean when used in a sentence? it essentially means on your US tax return, you need to translate every transaction that happens back to US dollars. And I happened to have had a client who had this happen in a good way, where she experienced an Australian dollar gain that happened over the course of the past 2 years, where the Aussie dollar has been progressively declining from about 78 cents down to 66 cents where it is today. So what's happened when you translate the gain that she's had in Aussie dollars back to US dollars, actually she gets a loss. So not so bad in that instance. But the flip side of that scenario is where you actually have a loss in Australian dollars, but then because of a rise in currency, it translates as a gain in US dollars. So that's really a knockout combination. You lose money in Australian dollars, and then you get a bill from the IRS because they say when you translate it back to US dollars, I'm afraid it looks like you made a profit. So what happens to these visa holders, legal permanent residents, or US citizens? It's actually, I should delete that visa holder because that does not apply. What happens to legal permanent residents or US citizens once they've renounced or relinquished their green cards? Well, after leaving the US and not passing the green card test nor the substantial presence test, they're no longer subject to citizenship-based taxation. However, what we need to look out for is that exit tax. I glossed over that earlier, and that's because earlier this year, I did a 90-minute deep dive on the exit tax and how it's calculated. And so for a higher net worth individual, they're probably going to have some planning to do and some tax to pay, or possibly both, if they meet one of the three tests that exists for the Heart Act and that exit tax. Okay, so broadly speaking, what are your options for distributing your US retirement account? Well, it really is actually, I misspoke, wrong heading there. Options for account distribution. Your options are going to vary. At the highest level, it's going to vary depending on what your US tax residency is. Are you a US citizen, permanent resident, or temporary visa holder? Good news if you're a temporary visa holder, but you'll have to stay patient because we'll come back to the situation with the visa holders a little bit longer. We have to go through the treatment for US citizens and permanent residents first, because that's the more complicated of the options here. So generally speaking, if you're a US person, you've got yourself a 401k, you can take penalty-free distributions from age 59 and a half. There is a 10% penalty tax withdrawal if you take distributions prior to 59 and a half, except for hardships. Loans may be available up to 50% or $50,000 of the account balance, whichever is less. Traditional IRA, similar story there. It's going to come out ordinary income taxation plus 10%. And you may take up to $10,000 for your first home. Higher education costs or hardship withdrawals. So this is actually, for the tax nerds out there, this is actually why Australia doesn't view the US retirement account system as being comparable to superannuation, because unlike superannuation, you can't get your money out at all unless you meet one of these hardship type provisions. And you believe me, you don't want to meet those because it's things like terminal illness, bankruptcy, and that kind of thing. So Australia takes a dim view. They say this is not equivalent to our system, so we're not going to recognize it as a foreign superannuation system. Okay, that being the case, let's continue here. So what are your options? I jumped the gun 2 slides ago. Here's what I meant to say. Your options are: you can either distribute according to the regular US tax rules, which is what every domestic client is going to do with their 401ks or 403bs or IRAs. As they distribute them, they're going to pay the taxes you see right here in the bottom right-hand corner. There's your 2024 federal tax rate schedule for single filers and for married filing joint filers. They're going to pay that ordinary income rate as applicable as they distribute their account and file their 1040s every year. Looks like a question's come in. Robert Bressi. Would the US allow a $10,000 exemption for early IRA withdrawals for a first... Okay. For a first home purchase deposit in a foreign country? Well, that's a fine question, and I don't know the answer to that. Would they allow that? That is a pretty obscure one. I don't think it matters if, and I won't give away anyone's information, but if you're not actually going to be a US person, then it would not matter anyway, because it wouldn't apply. If you're not a US person, you're looking at taking an Article 18(1) exemption, and that would not even come up. So thank you for the question. I'm going to say that that's answered. Thank you for keeping me on my toes. Next, you could pay progressive US ordinary income tax plus your 10% early withdrawal penalty if you want to get that money out prior to age 59 and a half. Now, in every webinar, there'll be someone that will say, oh, actually, hold on. What about Section 72T, substantially equal periodic payments? This is true. Yes, that's a thing. If you take substantially equal periodic payments over a minimum of 5 years, then you don't get hit with the penalty tax. So Katrina writes, do they treat Roths the same? No, they don't. The treatment for Roths is a little bit more complicated, but we don't like Roths anyway for folks that are intending to move back to Australia, and that will make sense towards the end of the presentation, Katrina, when I talk about how the ATO taxes US retirement accounts. And the short answer there is they don't distinguish between your traditional tax deferred variety, like your traditional IRA or a 401k, and Roths. So Roths can end up paying tax twice, which is why we don't like them. Someone's chatted in here, Katrina, do they treat Roths? Okay, it's the same thing. Okay, next. Or alternatively, for non-US persons, you can take a tax treaty approach by completing Form W8B. And here it is. This is what the current form looks like. And then right down here, claim of tax treaty benefits. You'd send this off to Schwab or Fidelity or Interactive Brokers or whoever your US custodian happens to be. And in most instances, they're going to say, thank you very much for sending that in. We are not going to pay any attention to what you've submitted to us because we have exactly nothing to gain and everything to lose by essentially following what this form says. So we're just going to withhold 20% no matter what. You take it up with the IRS next year when you file your taxes. Okay, so those are the three choices that or three options that happen there. So what are your options for getting your funds out of your US retirement account? Well, for US persons, likely, and this is what I'm always at pains to say and emphasize and bang the table and emphasize is, likely the most effective tax approach is going to be to stretch the distribution over several years to result in the lowest adjusted gross income, thus keeping the majority of your distribution taxed at lower levels. It's simple averaging. Do not make such a large distribution that you cause your tax bracket to spike into a higher bracket because you just made a tip. You just gave the IRS a tip, said, thanks, guys, you're doing such a great job. Here's some extra money, and you didn't need to do it. The Secure Act of 2019 came in, and it threw a wrench in the works, as some of my clients know who have received inheritances of deceased that passed post-2020. And what that did is they said you used to be able to take the IRA distribution over the remainder of your lifespan. And why did we like that? Because we could take it over more years and lower the tax impact. Unfortunately, with the Secure Act of 2019, they've said you've got to take it over 10 years. And that's a problem because when you think about the age gap between most adults who are most commonly the heirs and their parents, typically you find that the adult children are in their prime income earning years. And so they're already in the top tax brackets. And then to add insult to injury, now we've got to distribute this retirement account over these top earning years and thus pay a higher rate of tax. The only situation I've seen worse, and this is one that just made me wince with pain on behalf of the client, was a client whose father, he nominated the IRA. What did he do? He nominated a trust as the beneficiary of his IRA. and did not specifically nominate people. It just said, to my heirs. And if you do that, then they actually give you a 5-year distribution window. So even worse. So this client's making $500,000 a year. Throw on top of that the $1 million that he's inheriting from the IRA that he needs to distribute over the 5-year period. So he's just spiked his income by $200,000 a year. Okay, the questions keep rolling in. Okay, Simon. Hi, Simon. I am 53, been in the US for 20 years, a green card holder, have about 350 in 401k. Looking to move back to Australia in the next 6 months. Great. After the sale of house and paying off debts, I will move with about 120,000. Due to daughter being here in the US, I was considering becoming a citizen so I can come and go. Fair enough, and that's what happens in the real world, by the way. It's not always just about finances and what gets you the lowest tax bill. It's about your loved ones and the fear of not being able to get back in. Should a certain candidate become president again, then that might become very difficult for everyone coming back, trying to get back into the US. That may be a bad idea and just relinquish my green card right. And that's the thing. I'd say there's no right answer. It's really financially, there's more to it. We need to look at it. Do you have any exit tax exposure? It sounds like you don't, but that may not be everything that you've listed there. How comfortable would you be just coming back in on a temporary visa or a tourist visa of some kind? And they at 59.5, I can figure out how to get 401k money back to Oz. Well, you could do better than that if you got out of the US as a non-covered expat, which is what the higher income earning folks or the higher net worth folks are called when you go through the US exit tax system. So really, Simon, I guess that there's maybe too much detail to really give you a strong answer one way or the other, but I would say pros of keeping your green card, firstly, it's going to lapse anyway after 2 years. So there's that. So you would you're really looking at becoming a citizen or giving it up altogether. If you give it up altogether, is there an exit tax exposure? If you keep it, is the hassle that I mentioned, or all the hassles that I mentioned earlier, are they going to be worth it given the relative ease you'll have of traveling back to the US? Laura, on the chat side of things, right, is that a problem if the heirs are all Australian and their earnings are not subject to US tax? Laura, I'm going to need more context to what you were talking about there. Is what a problem if the heirs are all Australian and their earnings are not subject? Now, by that, do you mean IRAs and 401ks that would be that would otherwise be subject? Yeah, that's a tricky one. That is a tricky one. Yeah. You would have to talk about that offline because I see what you mean. Firstly, getting the money out to non-US individuals, that's a chore unto itself. If they're not US, if they don't have social security numbers, they're not US individuals. And then if you did roll it over, I could see that you actually could use the treaty at that point. That's just my thinking out loud. And as I said at the beginning, this is not personal advice. This is general advice, but it is an interesting thing to talk about. Okay, so that's what we were looking at just a moment ago, was the Secure Act. So many individuals, they have the desire, this impulsive reflex. They say, you know what, I'm done. I've spent my 10 or 20 years working in the US. I'm going to move back to Australia and retire, and I'm just going to get all my money out, and I'm going to continue to be a US citizen, or I'm going to hang on to my green card for years and figure out what the situation is there. Well, such a hasty response can be costly, and here's why. In the US, and because of the lottery conundrum, in the US, if you win the lottery, unlike in Australia, it is taxable, and they give you two choices. They'd say you can either take the jackpot minus your state and federal income tax as it applies, depending on the amount. But if you were in New York or California and you won a sum like that, $512 million, you're probably looking at, if you were in Manhattan with city taxes there, you're probably looking at a 50% marginal, north of 50% even marginal rate on that. So they would say, here's your 266,000 or whatever that is, the $256,000 lump sum after taxes. Or they could say, you know what, we're not going to do that. We're going to pay it to you over 30 years. And the net present value of that total amount is going to be much more than the 256 because we're keeping your effective tax rate down. That is the name of the game. That's what we're trying to do here with these IRA distributions. Okay. So what's the appropriate tax withholding? Well, this is where it gets interesting. If you call up Schwab or Fidelity, Merrill Lynch, whoever, they're going to say, oh, listen, it's 20%, may increase to 30% if they're reading their little cheat sheet. They'd say you're a non-resident, non-US citizen, otherwise known as a non-resident alien. Not true, by the way, given the Australian tax treaty, but we'll get to that in a minute. It needn't be applied in the first place who exercise their treaty rights, because right here under Article 18, it says pensions and other similar remuneration. This is what it says if you download it from the internet right now, from the Australian government or the US government. It says exactly this: paid to an individual who is a resident of one of the contracting states in consideration of past employment shall be taxable only in that state. Now, there are a few more nuances and detail that go into that, but it's not that much. It's pretty straightforward. So that's what the tax treaty says. And I have to say it's embarrassing, it's terrible, and they need to be pressured to change their rule. But Schwab used to apply that. Charles Schwab, until March of 2022, they'd say, yep, we agree, it's 0%. And in fact, in the IRS's technical guidance, in fact, I'm going to take a brief break just to show you this. This is not part of the regularly scheduled programming, but it's something I feel so passionate about. I want to actually just show you this so you know what I'm talking about. If we look at the IRS's technical guidance, which I'm just bringing up here, there's a tax treaty table that they publish. I'm going to zoom way into this. What we're about to see is an IRS publication. Okay, so I'm resharing my screen. Tax rates on income other than personal services income from various countries. So here we see at the top is Australia. Interest is taxed at 10%. There's the treaty article citation. Okay, so that's interest. Dividends, 15%, qualifying for direct dividend rate. That's great, 5%. That's really good. But what we're here talking about tonight is pensions and annuities. So Article 18.1, just as I said, what's the appropriate withholding? It says it right there, 0%. Okay, so this is not a controversial opinion, I should say. I'm just going to go back to the presentation now. So 1 second as I bring all of that up again. Okay. So what to do if your account is over withheld? Because it's very likely going to be over withheld. One custodian we work with, Interactive Brokers, they still will do the 0% withholding, but it takes an enormous amount of effort to get them to do it. And it's gotten to the point now where it's so difficult and stressful and time consuming for me and my clients that I would actually rather just not do it and go through the third option that you see here. And that is wait until you file your tax return the following year and make your treaty argument in your tax return and get the over withheld funds back at that point in time. Just seeing if there's any questions here. Carl has written in, does that apply to US citizens in Australia? Certainly does not. Absolutely, positively does not. Not one bit. No, that's what I just said, spent the first half of the presentation saying, is if you're a US person, doesn't matter where you are, what you do, or who you talk to, you are always a US tax resident, and thus you will always pay the US tax rates. Okay, so is now a good time, generally speaking, is now a good time to get these funds back? I would say Yes. Broadly speaking, is it an optimal time? I was just writing to a client earlier this week, and I said, yeah, I wouldn't take all of it out right now because it's peaked up a little bit based on some inflation numbers that came out last Wednesday. It seems to be trending back down a little bit. It hasn't moved that much at all, but I'm just not that bullish on the strength of the Australian dollar right now. We're hovering around, as you can see here, this is only about an hour ago, 66.6. And that's very close to that low we got in October of last year, around 63 cents. But look at this trend going back since early 2021. We've come down from 79 cents down to 66. So I don't see that changing very much in the short term based on the export, the primary export markets that Australia has, which is largely China and resources to them, given that the Chinese are on the ropes with, thank you, Carl, you got my sense of humor there, with all the tariffs and sanctions and difficulty they're having in their own real estate market. Tony Van Gelder. I'm a US and Australian citizen. My wife is a green card holder. If we move back to Australia, she gives up her green card to avoid US taxes for the rest of her life. What happens when I still have to file as married filing jointly? My goodness, Tony, this tells me one thing about your viewership of my webinars, and that is you did not watch last month's presentation because it is to do with exactly this topic. I mean, it is an hour dedicated to talking about precisely that topic. That's the 6013G election that you need to think about. So I'd say go watch that webinar, and you'll have a very informed perspective then. So how to convert your money back from US dollars to Australian dollars. Here's the spreadsheet that I use to talk folks through it. I really, really hope to educate the public on the business model that's used for foreign exchange. What is ignorant, what is naive, is to say, I get a better rate from fill in the blank, from TransferWise, from CBA, from the person who works at the back of the flea market. And I have heard that, by the way. That's actually true. I say it tongue-in-cheek, but I kid you not, there's someone who truly believes they got a better rate from someone at the back of the flea market. No, it's the rate, the foreign exchange rate is changing every second of every day. And what you see here is that exchange rate is known as the interbank rate, the one where there's no fee applied. If you were a bank dealing with another bank, that's the rate that you would get. I don't own a bank, you don't own a bank, so we have to pay a fee. The lowest out there is Interactive Brokers, and they charge next to nothing. However, Interactive Brokers, you get what you pay for, and the customer service and usability is very, very difficult, to say the least. OFX, we've negotiated this rate that's half of the retail rate, which is what you'd get at Wise or anywhere else. And so for large transfers, that's really a value add right there. But OFX and TransferWise, they're really locked. The horns are locked, and they're trying to beat each other with algorithmic pricing, but it averages out to about 60 basis points. The absolute worst thing you could do is use one of those Travelex tellers at the airport, but not much worse than that would be to say, well, I'm a member of CBA Private Bank or JP Morgan Private Bank, and I use their foreign exchange rate because I'm a special private client customer. No, you're not. Actually, you're getting an appalling rate, which maybe is not as bad as their retail rate, but is nowhere near the other rates that we see right here. So just so you know, private banks, no, it's maybe useful for getting a better mortgage rate or getting a mortgage on a property in a foreign country. We don't have any assets. Those are the only two instances I've ever seen where they have a distinct advantage. Another question just rolled in. Okay, Tony, you're welcome. Clay, if you leave the US permanently, is there a time frame you need to close your 401k account, or you can wait until the exchange is most favorable? There isn't a time frame, or at least there isn't unless your 401k provider or / employer gives you the heave ho and sends you a check and says, Clay, it was great, thanks for your service. Otherwise, If you were worried about that, you could roll it into an IRA, and then you really have all the time in the world to think about it. But it's trickier than that, Clay. As you're about to see, the second part of the answer to your question happens when you get back to Australia, because that's when the measuring period on the Australian side starts. And they say, well, we consider the taxable basis of the account to be the employer contribution, the employee contribution. And so thus everything else above that is ordinary income taxable in Australia. So could you wait till the exchange rate improves? Yes, but it's not the only variable. How much growth is occurring in that time, and what's your Australian marginal tax rate look like? Ben, thank you for your question. I have heard of people withdrawing 401ks when they leave the US as a visa holder, then claiming tax-free to be taxed at 0%. Well, that is funny you mentioned that, because that's exactly what I just said. Combining that with the capital gains step up back in Australia theoretically would mean zero tax on 401k withdrawals. Yes. Have you seen any clients successfully pulling this off? Well, yes, but remember, Ben, thank you for that. So I'm here to provide this as a public service and make it be known how these things operate. But there's still some tricks that I keep up my sleeve for achieving those kind of results that you're alluding to. But yes, that is indeed possible, and leading practitioners support the possibility of that. And even one step further, Ben, I'm going to really wet your whistle with this one. If you've got low basis assets on top of that, let's say you worked at a tech company, you've been there for a number of years, you've got low basis assets, you're going to move back to Australia. Well, if you never become a long-term US resident or citizen, and you come back to Australia, then you get a step up in basis on those assets to the fair market value on the date you resume Australian tax residency. Michelle, with 0% withholding, I was hit with 30%. Well, I'm sorry to hear that. I surrendered my green card and moved back to Australia. Do I try and reclaim 30% back on my tax, or 10%? Depends. This is the thing, Michelle. Your question really cannot be answered without knowing the differing time frames of when this happened. So if you still had your green card and you withdrew your funds, well, it would have been appropriate that ordinary income plus 10% would have applied. If, however, in a previous tax year, you had relinquished your green card and you were not a long-term resident of the US, you weren't a covered expat, and then you withdrew your account, then you should be looking for a full refund of that 30%. It just depends on the sequence of events and who could claim you as a tax resident at what time. Okay, so what to do with your money once it's back in Australia? Keep in mind, a lot of people operate on this unconscious assumption that because it was in a US retirement account, it must go into superannuation, the Australian retirement account system. Not true. Once it's out of the US tax system, you can do whatever you want with it. Of course, I am almost always saying that superannuation is the best place for you to put it. And the reason for that is because the Australian tax system is very fair. It's principles-based. For long-time viewers, you'll know the detailed comparison I've done between a principles-based system and a rules-based system. And in Australia, they want to make it very attractive to contribute and self-fund your own retirement, because that's what you're doing. In the US, you're doing it through three ways. There's the tripod system they have in the US. It's through Social Security taxes. So you vest in Social Security and you get a benefit later. You've also got your 401k, so tax deduction now, but it comes out fully ordinary income taxable at retirement. And back in the old days, you'd get the company pension as well. Although the company pensions have largely gone the way of the dodo, unfortunately. So here you see the residence tax rate and the non-residence tax rate. I'm going to come to a slide just now, excuse me, where I talk about two strategies that really make it attractive to get those US retirement funds back into superannuation. And this is how to do them. Depending on your age, depending on your employment status, depending on your Well, those are really the two things, actually, the age and employment status. So I just spoke with a client today where we said, this is absolutely what you want to do. Number one here, you want to make use of these non-concessional contributions. She's 67. We want to max out these non-concessional contributions to get in as much as 110 in the current tax year. And then if she defers, if she's able to do another contribution next year, she can make use of this 3-year bring forward rule and contribute up to $360,000. So that would be quite a handsome contribution indeed. Why superannuation? I think a con of superannuation is that the expected returns and the investment choices are quite limited. So depending on what your expectation is for expected returns from an Australian superannuation fund versus anything you could invest in the US, you might say, even with the tax disadvantages, keeping it outside super, maybe it's worth keeping it outside super. On the whole, for most people, I would say if you put it in a tax-free environment, then it's very likely going to be offer a superior return. So that's why I said recontribute it back to super. The other strategy that's available is the 5-year retroactive carry forward of concessional contributions. So beginning in the 2018 tax year, 2018-19, they would allow you to, if you have a super balance less than $500,000, then you could go back up to 5 years. Of course, that was the first year that you could do it, so there was no going back prior to that time. But now you can go back, and if you haven't contributed 1 penny as a concessional contribution to your super account in the past 5 years, well, I've got good news for you, especially if you're going to be entering the Australian workforce, because if you're entering the workforce, you're going to have taxable income. And this is a way of reducing your taxable income and simultaneously getting money into super. So this really is a fantastic strategy. One thing to keep in mind, however, and I think this is a warning that should be better labeled, because it's really not. Superannuation providers talk out of both sides of their mouths when they say it's tax deductible contribution. Well, yes, that's true. It is tax deductible to you personally, but what they don't tell you, and this is the talking out the other side of their mouth, is that there's a contribution tax of 15%. So when you contribute to your super fund, great, I'm getting a personal tax deduction that's going to show up on my personal return, but that's also my money. And if you're taking 15% out of it anyway, then don't tell me it's really a 100% tax deductible contribution, because my net equity, my net worth is what I'm concerned with. And whether you call it a personal tax deduction or a contribution tax, I don't care. I'm still getting taxed on that a little bit. So for older individuals coming back, going straight into retirement, that's why I would say don't bother with these retroactive contributions. You're not going to be working anyway. And there's a superannuation contributions tax of 15%. So just do the 3-year bring forward rule. Okay. ATO tax, this was in answering a question that came up somewhat earlier. I think this was Mr. Clay J. Clay J is a nice rhyme to that name. So the IRA or 401k is not a foreign superannuation fund as the ATO thinks of it, because you can get your money out at any time, albeit with penalty tax owed. But they say this is not comparable to how we roll in Australia. So we're not going to allow just this rollover type treatment. The distribution of an IRA should be included in the individual's income for Australian tax purposes, minus the corpus of this foreign trust, which is how they think of it. To Katrina's question earlier, same treatment for a Roth as it is for a 403b, as it is for an IRA, as it is a traditional IRA, as it is for a 401k. And also for if you were going to roll over a pension plan, which you would roll to an IRA anyway, so maybe that doesn't matter. But here's the thing. The growth on the account is what is taxable income. And if you're coming to Australia with significant growth on the account, just going back a slide, that's where making one of these retroactive carry forward concessional contributions could come in handy, because you could wipe out all of the tax due on the growth of your account by making a concessional contribution. Okay, so it's only the growth that's taxed. It's very likely for someone who's been in the US for, let's say, the last 10 years, growth is almost certainly going to be a smaller component. I have had a couple clients who've come over from working in the 80s, and it's actually the opposite. You know, their contribution is tiny and most of the account is taxable. In that instance, it gets a bit tricky, where it's a bit of a coin toss between whether they'd be better off taking it as taxable income through the US system or taking it through the Australian system or some hybrid of the two. That's why we get paid, is to run those sorts of analyses and figure out where it makes more sense. Antonia, good to see you. Hope you had fun at your dinner last week. If in Houston, if you do the retroactive contributions, but then don't actually earn the dollars, that yes, there are. You just made a 15% contributions tax to the ATO you didn't need to make, which is why I would favor for someone, if they were in a situation perhaps where they were thinking of retiring to Australia and not working, then I would say do not do the concessional contribution carrybacks, because what's the point? You could get money into you could get the 360 into super and continue to do that all the way up until I think it's age 75. I have to double check that. There is a cutoff age at which you can no longer contribute to concessional contributions for. But then, Antonia, this comes back to, and you'll probably know what I'm referring to right here, expected contributions. If you could get 11.8% from a senior secured first lien private credit strategy in the US versus X% in Australia, albeit tax-free, then it's not so easy to compare the two. I think there was another question over here. There were a couple more. Katrina, we are dual citizens from the US, Australia. We live 5 years in US and 5 years in Oz. After 60, is it better to take the money out of Roth to live on when we are living in the US? Yeah, I think it would be, but sparingly. And this is, Katrina, this is why you need, I would say, self-serving of me perhaps to say, this is why you need a financial advisor, is to go through these finer points, is how much, when to take from your Roth. And the answer to that, I won't keep you in suspense, is it really should be used sparingly for tax bracket management. So you want to draw from it. Often Roths are the smallest of the accounts that folks have, given the contribution limits that go with the various account types. Most people tend to have larger 401ks or taxable brokerage accounts. And what you would do is take strategically from those buckets in a manner such that it doesn't push you into the next highest bracket. The one terrible tax result is to go from the 12% bracket to the 22% bracket. It's the largest increase in the progressive tax rate system that's there. The rest of them are all much smaller. So if you could take from your Roth for the amount that would otherwise push you into a 22% rate, you're saving 10% tax on every dollar there. Anonymous attendee, could you transfer an IRA to a new IRA right before moving back to Australia so the contributions look much higher and growth is minimal? What did I say earlier, anonymous attendee? That's not a bad idea at all. Okay, supplemental slides that I've got here. I included these because they don't tie in neatly necessarily to any of the other points that I was making earlier. But here are the different phases of a retirement plan. So you've got your defined contribution type plans. There's your 401ks, 403bs, traditional IRAs. And the way they work is your contribution is tax deductible. You've got post-tax contributions that can be allowed, and that is by definition post-tax, so tax has been paid. Employer contributions are also they're tax deductible. Account growth is tax-free, but it's ordinary income when it comes out eventually, and that's where they get you, is what the government giveth, the government taketh away in the US. Australia doesn't work like that. They give you, yes, a 15% contributions tax, but once it's in there, it's growing, and it's not tax-free, it's concessionally taxed at 10 or 15% growth while it's in there. But then when it hits the pension phase, the distribution phase, it's tax-free. And that's a wonderful thing. But that's because Australia's approached this problem of funding their citizens' retirements fundamentally differently. And that is, Australia does have an aged pension, but it is really bare bones. It is poverty level type income. So what they're trying to do is make it very attractive for individuals to self-fund their retirement. And that's why there's also a lifetime contribution cap on superannuation at about, I believe it's about 1.8 million per piece right now. So you can put in up to 1.8 million into your super, but no more than that. And if you do, you lose your tax benefits for being in super in the first place. So post-tax contribution types accounts, these are all of your Roths, Katrina. So it's going in post-tax, it's ordinary income, subject to progressive tax scale if your employer did contribute. Well, it comes out tax-free in the US at least. In Australia, I've already spoken about that. And then you've got your defined benefit type accounts. These are your pensions. So you can't really make a contribution. It's all formula driven. What your employer's contributing, it's growing tax-free in the growth phase, but then it's also coming out this and being taxed the same as the defined contribution account. Next, we have a whole lot of numbers here that may be very confusing to you. So let's not worry about that 345 for a minute. We really need to focus on what you see in the middle of the table. That's the $23,000. If you're over 50, you can do up to $7,500 to catch up. So $30,500, very nice to do. The message that I hope that gets out to the expat community here is, even if you're in the US for a short period of time, you still want to fund your 401k because the tax benefits make it worthwhile. Even if there's an average plan selection, if you're starting to make real money getting up, say in the 24% bracket or above, then the tax deduction is very valuable. And again, if you can get that back to Australia tax-free, then rarely do investment or retirement savings options come better than that. And lucky last here is just an RMD table, required minimum distributions. And I put this in here to talk about how US individuals would otherwise have to, or they're going to have to take RMDs from age 73. And this is the way it's determined, is they use a life expectancy factor and then divide that by the balance of the account as it was on the last day of the year. And there's your RMD for that given year. If I'm going to hold that question just for a second there, Simon. If you feel like my firm may be of assistance to you, then feel free to go to Arete-WA right there and click on the Get Started. That'll talk about our prospecting process. We work with clients who have investable assets of $750,000 and think that we bring tremendous value to our clients over and above our fees. You can also go to the website and download a number of white papers. There's a bunch of blog posts. The key financial data sheet is there. Next month, I alluded to this, I'll be talking about the art and science of determining how much of your wealth to hold in the US versus Australia. I hope you can make that. These webinars, in case you haven't picked it up, always the third Tuesday of the month, always at 7:30 Central Time. And I've found that works best with folks in Australia, East Coast, West Coast, etc. So questions and answers. Please take a moment to get your questions in. I'll just look at Simon's, read his question very quickly. So if I relinquish my green card, I don't necessarily have to wait until I am 50 and a half to access the 401k. Bingo. But you do need to see if you're a covered expat. So you could still be bitten by the US tax code. I could withdraw it all after the green card relinquish and send money to Australia. And if they charge me penalties for withdrawing and claim that back, you got it. If that's your fact pattern, of course, you want to double, triple check, talk to your CPA about that. But that is exactly correct. If you are not a covered expat, because if you are, then you're going to have some unpleasant surprises waiting for you. Martin, you're most welcome, and thank you. That's very kind of you to say. I appreciate that very much. I'll be in touch with answers to emails, to client emails, I might add, tomorrow. Jody's written in, can you put the last 2 pages, next webinar back up again? Yep, I can. There it is. And Katrina, thank you. Also appreciate Simon. Thank you, mate. Appreciate all your info. You're welcome. Nancy, I hope you were able to connect with Mel. Ashley, get better and better on this complex information. Thank you so much. Well, given that folks have had a second now to write their questions, thank you, Carl. I'm going to presume that that's everything. And thank you very much. Please don't keep me a secret out there in the real world. If you know of someone who has a complex financial life and would benefit from professional assistance, then I just ask you to make an introduction. Thank you very much, everyone, and have a wonderful night. See you later. Till next time. Bye-bye.